Basic principle of investing is buy low and sell high. So we should buy company stock when it is undervalued and sell it when it is overvalued. But how do we know whether it's overvalued or undervalued? And how does it compare to its others in its industry or competitors? So the granddaddy of all valuation stock ratios of almost all is the price to earnings ratio. You might hear it known as PE ratio or price to earnings ratio, which is very famous when it is used. That's why when you go online and you look for a stock price or a stock quote, usually right around there you'll see a PE ratio around that price somewhere. Certainly if there's a little bit of summary of that stock, you usually have PE ratio next to it because you are really comparing the price to its earnings, and that's the formula of ratio behind it. Price per share divided by earnings per share. Now the nice thing about all these ratios is you don't have to manually calculate them. It is right off the income statement. You can find them in your income statement. But basically it is the price of earnings, and think of price of earnings as what would you pay for say 1 rupee of that earnings of that stock. So for every rupee of offerings, this is what you should maybe pay in terms of price that doesn't match the way sometimes the market is overvalued or sometimes it is undervalued. But that's the idea behind it. And really all you're looking for the PE ratio is to compare among other companies, and then general rule of thumb over many years was that lower PE ratios are of good value. Low PE can vary from industry to industry. For example, maybe a technology industry all might have a very high priced earnings ratio as far as companies, because people are expecting high tech companies equals to high growth things from that, versus a more stable industry like utilities or things like coal company or things like electricity that don't have a very high valuation. Now what we know in recent market times, rule of thumb can really go out of window in some areas, and certainly price earnings ratios are like that to you, where you might see a really high price earnings ratio of some utilities, and same thing with technology stocks might be lower, but they tend to be much higher as well too. So the thing is that if that's a higher number, if you have a ratio of 15 and either company has one of 10, well, that's better value if it is 10 in comparison to price to its earnings. Now there's a lot of other factors that go into picking stocks. Don't just go behind PE ratio or any other ratio for the matter of fact, but it is something that's a good tool comparing two companies, and they are very close in terms of what they pay for dividends or income or growth rates. Sometimes you might hear a commentator say, well, this stock is overvalued or the market is overvalued. They are saying that they are usually referring to the PE ratio. Now, what is a good PE ratio? As mentioned earlier, stocks in different sectors trade in different valuation ranges. Usually, stocks with higher growth earnings, they have a potential of higher PE ratios. Therefore, we cannot use a single PE level across all stocks to infer whether the price is attractive or not. You should look at historical PE of all stocks and see if current PE is near the end of that range or lower end of that range. As far as Nifty is concerned, it has traded in PE range of 10 to 30 historically. Average PE of Nifty in last 20 years was 20. So PE ratio below 20 may provide good investment opportunity. Lower the PE below 20, the better the investment potential. Now to check out how to invest in gold the best way, click here. Hit the subscribe button to stay updated on upcoming series, and if you guys enjoyed this video, do consider smashing the like button. Until then, my name is Vishal. Thank you for watching. I'll catch you next Sunday, 4 p.m.